When we think about bonds, we often picture them as a safe haven for investors, but there's so much more to them. Bonds are essentially loans that investors give to borrowers, typically governments or corporations. When you buy a bond, you're lending money in exchange for periodic interest payments and the return of the bond's face value when it matures. Now, let's dive into the characteristics of bonds. First, we have the face value, which is the amount paid back to the bondholder at maturity. Then there's the coupon rate, which determines the interest payments you receive. The maturity date is crucial too. It tells you when you'll get your money back. Bonds can also vary in terms of credit quality, which reflects the issuer's ability to repay. Higher credit quality usually means lower risk, but it also means lower returns. Valuing a bond is essential for both investors and companies. For investors, it helps determine whether a bond is a good buy at its current price. For companies, understanding bond valuation is crucial for pricing their own bonds effectively. The process involves calculating the present value of future cash flows, which include the coupon payments and the face value at maturity. This is where discounting comes into play, using the market interest rate to find the present value. Now, let's talk about why this is essential for a company. When a company issues bonds, it's essentially borrowing money. A well-priced bond can attract investors, ensuring the company raises the funds it needs for growth or operations. If a bond is overpriced, it might not sell, leading to missed opportunities for financing. There are several types of bonds out there. Government bonds, like U.S. Treasuries, are considered very safe. Corporate bonds carry more risk, but often offer higher returns. Municipal bonds are issued by states or local governments and can provide tax advantages. Then we have zero-coupon bonds, which don't pay interest but are sold at a discount and mature at face value. One of the most important relationships in finance is between bond prices and interest rates. When interest rates rise, existing bond prices typically fall. This happens because new bonds are issued with higher rates, making older bonds less attractive. Conversely, when interest rates drop, existing bonds with higher rates become more valuable. This inverse relationship is crucial for investors to understand, as it can significantly impact their investment strategies. In summary, bonds are a fascinating investment vehicle with unique characteristics and valuation methods. Understanding the types of bonds and the relationship between bond prices and interest rates is essential for making informed investment decisions. Whether you're a seasoned investor or just starting, grasping these concepts can help you navigate the bond market effectively.